Okay, welcome to the ultimate guide to selling cash secured puts for income. Now, I'm pretty excited to share with you this strategy because this is one of those strategy where you get a sell premium and you get to get paid while waiting to get your stocks filled. So a lot of people like this strategy. So I'm going to share with you exactly what this is. So first of all, what is a cash secured put and how does it work? So very simply put, it's just selling a put on a stock which you wish to own 100 shares of, and then you receive a premium while waiting to get filled. For example, if you were to sell a cash secured put at the $70 strike price, okay, and you want to get filled at this price, it means that you need $7,000 to buy this 100 shares if the stock expires below $70. Okay, so this is what a cash secured put essentially means. Now, there's a difference between a cash secured put and a naked put. All right, a naked put basically is just the opposite. It means that you do not have the funds to buy the 100 shares if you get assigned. And this is where a lot of people, especially where they want to quickly make a lot of money, tend to make the mistake because they will try and sell this put, get the premium upfront, and then hope that it goes up from here, and they just keep doing it. Now, in a market where if they time it properly, if the market keeps going up, yeah, they will always get this premium. But the problem comes when the market really crashes in a bear market, or when there's a huge retracement. This is where a lot of people can lose a lot of money, especially when they have over leveraged themselves. So, for example, if you will take a look at this is the Starbucks, right? If you were to see, the only amount that you have to put up to sell this put option is only $776, right? The current stock price right now is about $77.80, so it's roughly about 10% of the margin you have to put up, right? So some people with an account size of, let's say, $5,000, let me just pull up the calculator here, they will want to try and maximize this, right? So they take a look at their account size and they say it's $5,000, and they say, hey, I can get $145 for each option I can sell. So how many options can I sell? So they take a look at the margin that they require. They take their account size, $5,000, they divide it by $777, let's say, just round it off, and they say to themselves, oh wow, I can actually sell 6 option contracts, right? So that's what they do, because 6 option contracts, you times it by a premium of $145 which they receive, you receive $870. So they say to themselves, wow, this is easy money, I'm going to go ahead and just sell this. But this is where the big problem is, because they do not see that the risk actually lies down here. If you take a look at this box down here, you can see that the max loss is $6,855. And this is very simply derived by the fact that if you will get filled at the $70 strike price, right, if the stock was to go to zero, you would lose $70 per share. So each option contract has 100 shares. So you time this by 100, that's $7,000. You minus off this credit which you receive, this is your max loss. So imagine this, they go short 6 contracts, and then if the market or somehow or another, the stock actually goes to zero, they lose $6,855 times 6, that's $41,130. So that is why a lot of people, when they start to sell this put, they go naked. This is where they can get into a lot of trouble, and that's where a lot of margin calls comes in. So when you're using this strategy, remember, the number one intention of this strategy is to actually get filled. You want to buy the stock. Alright, so what happens at expiration day? So let's take a look. So let's say you sold the cash secured put at $70. Right now the stock of Starbucks is at $77.92. All right, $77.92. So it has roughly $7.90 to get to your strike price. So let's say you decided to sell it at this strike price and you receive a premium of $1.45. Now times 100 shares, that is $145. Right? So let's say the market closes above $70. What happens is that your cash secured put will expire worthless, and you get to keep the $1.45 in premium, which is $145. And all you have to do is just sell another cash secured put. So all you do is just rinse and repeat. So that is why a lot of people like to sell this, because if you were to just place a buy limit order, imagine you were to just place a buy limit order at $70. If the stock never goes down there, you don't even get anything, right? you don't get paid. But in this case, you would get $145 just for waiting, and you get to sell another cash secured put again. Alright, so what if Starbucks was to close below $70? So this is the strike price, it closed below $70. Well, in this case, your cash secured put is assigned. That means that you would have to buy 100 shares at this $70. So that means you are now long 100 shares at $70, and your effective price is actually $68.55. And the reason is because you have taken in $1.45 in premium. So this is the big difference compared to just placing a buy limit order. It's because now you have this premium to help you offset your cost price. So instead of buying at $70, you're now buying at $68.55. And imagine this, you can just sell again at a lower strike price and collect even more premium if you want to add on to this stock. You want to buy more shares of this stock. Okay, so selling the cash secured put, there are some pros and cons as well. So the first pros is that you actually get paid while you are waiting to buy the stock, right? You get the premium. If it doesn't get filled, you can keep getting it again. And this helps you reduce the effective price of the stocks as you collect premiums. So let's say, for example, you sell the cash secured put $1.45 again. Right now, you receive a total credit of $1.45. This goes to you no matter what. Okay? So imagine this. It expires worthless already at this point of time. You can sell another cash secured put again. So maybe this time you collect $1.55. So now you have a total credit of $3. And again, it expires worthless. And at this point of time, you can go ahead and sell another cash secured put. Now, let's say, for example, this time the stock goes all the way down and it closes below your strike price of $70 at expiration. So what happens now? First of all, you already collected the credit of $4, right? A total of $4, $1.45, $1.55, and $1. And then you get long at $70. So what is the effective cost price? So your effective price of the stock is $70 minus all the credit that you receive is $66. You can see this is so much better than if you had just placed a normal buy limit order at a $70 price. If you place a buy limit order, the stock goes down, you get filled at $70, that's it. The only way that you can make money is if the market goes back up. But in this case, you've already made $4, which is $400 on just by selling the cash secured put, and your break even is even lower. So what that means is that if the market was to just go up to $68, overall position would be in a profit. The other thing is that you can actually choose to keep rolling your cash secured put down to get a better price. So let's say you decided to sell the cash secured put again at $70. So this time the price goes down to $70, and then you think to yourself, I think I want to try and get a lower price. I don't want to get filled at $70 now. Alright, so if that's the case, what you can do is actually to roll your cash secured put down. You can actually roll it down to a lower price. So in case if the market does go all the way back down here and then you get exercise, you would now be long at $68. Right? Now, as you roll this cash secured put, you actually also start to collect additional credit. Right? So let's say you already collected $1.50 here. By rolling it down and then extending it to the following month's expiration or even further out, you can always get some credit, right? It might be a small credit, maybe it's as small as just 10 cents, that is $10. But that is much better than if you had been filled at $70 over here, when you could get filled at $68 and then you get an additional 10 cents. So these two credit will be added together, right? So you get a total credit of $1.60. Okay? So here's the thing. If the market was to drop again, you can in fact just roll it again. So how many times can you roll? You can actually just keep rolling perpetually as long as you can keep getting credit and as far out as the option can go, right? The only thing about rolling this is that you have to be rolling out in time. And when you roll out in time, your cash secured put may have started out in 30 days, but as you roll it, right, you may have started off 30 days, you may have to roll further, it becomes 60 days. If you roll out even further, maybe it becomes 120 days. And if you want to roll out even further again, maybe you have to go all the way to 180 days. So what that means is that even though you can get filled at a lower price, let's say you have rolled it all the way down to the 64 strike price from $70, the thing is that you have to wait 180 days later to see whether you get filled at this $64 price, right? So that is the only thing when you're rolling your cash secured put down. So the beauty is that you can just keep rolling it down, and if it goes down again, you can just keep rolling it down again. All right, so what are the cons? All right, there is just one cons, and the thing is that you will have to wait until expiration date to know if you can actually buy the 100 shares. For example, the stock goes down very quickly and then it bounces back up. Now, if you had been just long, if you had just placed a buy limit down here at $70, at this point of time when the market goes down past the $70, you would have already been filled 100 shares. And then when the market shoots back up, let's say it goes to $82, you can actually close it and realize a profit for $12 per share. And 100 shares, that'll be a total of $1,000, $1,200 in fact. So that's if you have placed a buy limit order. But if you did not place a buy limit order, all you did was just sell your cash secured put. Let's say all you receive is about $1.50 for this. What happens is that if the market was to go below, the stock was to go below $70 and then bounce back up before the expiration of your option, then all you'll be collecting is $1.50, which is just $150, and you lose out on all this capital gain. So that is the only trade-off that you have for cash secured put. But then again, you need to think where your risk lies, right? Your risk lies actually below. If the market was to go down, that's where your risk. So you want to think of it in case the market doesn't just bounce up, let's say, because we want to think of the worst case scenario. What if the market just goes all the way back down? Then you would have been better if you have sold the cash secured put, because you would have a lower effective price than if you had just gone long with a buy limit order down here. So that is why I would prefer to sell a cash secured put as opposed to just placing a buy limit order. Okay, so here are the 5 steps to selling cash secured put for income. Okay, step number 1. So you only want to sell on stocks that you want to own. Okay, that means that you want to find stocks that are fundamentally sound, fundamentally strong. You know that in the long run, they will go up because they are profitable, right? They are increasing their revenue, they're increasing their profits, increasing their cash as well. Okay, step 2 is to sell only when the market is on a wave down. That's when the volatility increases and you get juicier premiums. Because when the market goes up, right, volatility drops, and when the market goes down, volatility increases. So that is why we want to sell our cash secured put ideally when there is a wave down. So what is a wave down? This is a wave down, this is a wave up, this is a wave down, wave up, wave down. You get the point. So we want to sell it on the wave down. When it goes up, that is the time for us to sell covered calls. So when it's going up, we do not want to sell cash secured put, we sell covered calls. On the way down, we sell cash secured put. So step number 3 is to sell at a strike price that you're comfortable owning 100 shares at, and preferably below a support level. When we are selling cash secured put, we don't want to just sell it at any level. We want to be very smart. We want to be very strategic about it, because the last thing we want is to, just sell a cash secured put, let's say for example down here, and then we get stuck, right? The market goes all the way below and then it takes a long time before it goes back up again. So we want to find levels where there is a good chance the market will actually rebound back up once we either get filled, or when the market turns, we get profits of our cash secured put. So ideally, that will be always below a support level. So for example, $70 is a good support level, right? The price has bounced off here once, bounced off here twice. So there's a good chance that if the market was to come down here, even though if it was to cross below, there can be a good chance for it to bounce back up again, and then we will profit on our stock if we get exercise, right? The other thing we want to take a look at also is the indicator to see whether is it overbought or oversold. For example, this is the stochastic oscillator, right? So this can give us an indication where it might be a good time, or where is a good place to sell, where the market has a good chance to turn. For example, if the market right now is overbought, you see at this point, it's not smart for us to go and sell a cash secured put at this price, right? Because chances are the market is going to blow past it. We're going to get filled, and then it could take some time before the market goes up again. So we want to wait until ideally it's oversold or somewhere near this area. Okay, let me just clear this drawing, because you see that whenever it's oversold, there is a good chance that the market will bounce back up again, right? This point, it bounced back up. This point, it bounced back up. Now, of course, it doesn't work all the time. Like, for example, this point in time, right? It's oversold, but it continued to be more oversold as it went back down, right? So, at least in this way, we are able to put the odds in our favor when we sell the cash secured put. Let's say, for example, at this point down here, it is oversold. What you could do is actually place a level here to sell. Now, there's a chance that the moment it goes back down, we're going to get filled, right? If we get filled, it expires below, we're going to get long at $77.92. But you can see there has been a few opportunities for us to get out of our stock if you do not want to hold it for a long term. But it's still closed somewhere right now above the strike price, which would have been long at. That's because we use the indicator to give us an indication where it might be a good place to buy. So in this case, again, we find a support level, and then we want to wait until this indicator gets a little bit more oversold, probably somewhere down here and even down here, right? So at this point in time, most likely the stock will be here. Then you can go ahead and sell 70 or even $68 the strike price. So when selling cash secured put, we want to be smart, we want to be strategic about it. Step number 4 is to choose the options that are DTE 45 and below. That means there are 45 days or lesser to expiration. And the reason is very simple. The option starts to decay much faster. That means the value starts to decay much faster when it's 45 days and below. It starts to pick up speed. That's when it quickly exponentially loses its value. So if you were to take a look at the graph of the theta decays, it goes roughly something like this, right? So this is roughly the 45 days mark all the way to 0. That means as the days get shorter, you can see that the expiration gets increasingly faster. Right, and that's what we want as option premium sellers, right? We want the option to decay as quickly as possible. That's when we can quickly realize the full value. Okay, step number 5. And step number 5 is to sell only when you get a decent premium, where you have an annualized return on investment percentage of more than 20%. So the way you want to calculate it is very simple. So first of all, just take a look at this table. So this table shows all the different expiration dates. You have from number 44 days to 9 days, and this is all 70 strike price. So what you want to take a look at is the mark price to see what's the premium which we get. So in this case, we get $1.44. And the reason we want to take a look at the mark price is because that is the mid price between the bid and the ask spread. Now, we never want to sell off the bid price because that is the worst price that you can get. We always want to try and get it somewhere in between. And as you can see down here, the spread is quite big. So if you were to sell it off down here, you can see that you're losing out on quite a bit of premium. So we always want to get at the mark price. So for this strike, for this 44 days to expiration, we're selling it at $1.44. We divided it by the strike price which we're selling it at, and then we divide it again by the number of days left, and we times 365 days, and that gives us 17.06%. Now this is below the 20% that we are looking at. Generally, I like to look at it much higher. I like to see it when it's like 30 or 50%. Right, that means I have to wait until the stock drops a little bit lower. So let's say, for example, in this case, you do want to sell the 70 strike price. What you could do is to take a look at the other expiration dates as well to see what kind of premium which they're giving you. So if we were to take a look at the 23 days to expiration, we can get 85 cents in premium. So that's roughly $85. So the premium is 85 cents. But if you notice, after we have analyzed this, we actually get a higher percentage. We have a higher return compared to the 44 days. And in general, as there is lesser days to go, we actually generally have a higher return on investment percentage, right? The percentage wise tend to be a little bit higher. In this case, we also can take a look at the volatility down here. So this indicates to you how juicy the premiums can get. So if you were to take a look at the 44 days, you can see that there is only a volatility. The implied volatility is only 40.15% compared to 44%. That is why the premium here is slightly higher, and most likely that's because there's going to be earnings on this date. All right, most like, if I'm not wrong, Starbucks is going to release an earning on the 2nd of August, so that is why it will affect this option days to expiration, this particular option. That's why it's inflated slightly more than the others, right? So now let's take a look at DTE 9. So there are 9 days left to expiration. So again, we take the premium, which is roughly 17 cents, and then we divide it by $70, and then divide it by 9 days times 365 days, and you notice that we get actually a very measly return, which is only 9.85%. So in this case, we do not want to take a look at this whole option down here. We only want to take a look at either one of these two, right? Because they are the closest to 20%. Now, if you are not getting the kind of return in terms of percentage that you want, then you actually do not have to sell it off right now. You do not have to sell your premium. You do not have to sell the cash secured put right now. Instead, you can just wait until the market drops a little bit lower. So now it's at roughly $77.80. You might want to wait until the market maybe drops to around $75 or $73 before you take a look at all these premiums again. So when the market drops, volatility will increase, and as the market is nearer to the strike price, the premium will increase as well. So if you take a look at all this percentage, this premium, and you see that the return is not that great, then you don't want to sell it. Just wait for the market to drop, then you sell it again. Alright, that's it for this video. I hope you liked this video, guys, and if you really liked it, please subscribe and hit the notification bell so you will be informed whenever I release a new video like this. And as always, thank you for watching. I appreciate your time, and I'll see you in the next video.